The number sounds responsible. 6 months. It's been repeated so often that it feels like a law of physics. Save 6 months of expenses, park it in cash, and everything will be fine. I'm a Jazz, and with a master's in finance, years of studying how money actually behaves in the real world, not just in textbooks, there's something that needs to be said clearly. That rule doesn't hold up anymore. That belief created a sense of security for people like Lauren. 7 years of discipline, about $600 saved every single month. Slowly building a safety net that finally reached a clean, satisfying number. $52,000. Exactly what 6 months of expenses looked like at $8,700 per month. That number didn't just represent money, it represented control, stability, proof that things were being done the right way. But there's a problem hiding behind that number. Nothing about the economy that created that rule still exists. That $52,000 is sitting in a savings account earning 4%. On paper, that looks reasonable, safe, even smart, but inflation is running at 6%. So every single year, that safe money is quietly losing 2% in real value. Not in a dramatic, visible way, no warning signs, no alerts. The balance doesn't drop, it still shows $52,000. But what that money can actually buy shrinks by more than $3,000 in purchasing power every year. And that's the part most people miss, because nothing looks broken. That's what makes this dangerous. 3 years pass, and the account still says $52,000. But in real terms, it behaves more like $42,800. The safety net didn't disappear, it eroded. Quietly. Now layer that on top of what's actually happening in 2026. Essential costs aren't stable anymore. They're up roughly 37%. Housing, food, insurance, utilities, everything that keeps daily life running costs significantly more than it did just a few years ago. And those aren't optional expenses. Those are the ones that don't pause when income stops. That's where the 6-month rule starts to fall apart. Because it assumes a world where expenses are predictable and temporary problems stay temporary. But reality looks different now. Look at retirees. This is where things get uncomfortable. These are people who had decades to prepare, decades to plan, adjust, and optimize. If any group should be financially stable, it's this one. Yet the average retiree household is spending around $5,000 a month. That's about $60,000 a year. Housing alone eats up 30% to 36% of that. Healthcare becomes a massive long-term cost, with estimates around $172,000 over retirement. And despite all that planning, many retirees report the same issue. Their expenses are higher than expected. That's not a small mistake. That's a structural failure in how people estimate risk. Because the assumption was always that careful planning leads to accurate outcomes. But the data shows something else. People underestimate. They underestimate how long money needs to last. They underestimate how fast costs rise. They underestimate how unpredictable healthcare becomes. They underestimate how small, repeated expenses, subscriptions, delivery services, convenient spending, quietly compound. And if that's happening to people planning for 20 to 30 years, then a 6-month buffer starts to look dangerously thin. Now bring that back to Lauren. The plan was simple. 6 months in cash, total safety. But that plan assumes something very specific. It assumes that emergencies are short. It assumes income recovers quickly. It assumes costs behave. None of those assumptions hold anymore. Job markets have changed. Layoffs happen faster. Hiring takes longer. Contract work replaces stability. Recovery timelines stretch out. An income gap is no longer a 3-month inconvenience. It can easily become a 9-month problem. And during that time, expenses don't freeze, they expand. Insurance premiums go up, grocery bills fluctuate, unexpected costs show up at the worst possible time. That's why the 6-month number doesn't just feel outdated, it's structurally incomplete, because it treats all emergencies as if they're the same. But they're not. A $500 car repair and a 9-month job loss are both emergencies, but they behave completely differently. One needs money immediately. The other unfolds over time. And that difference changes everything. Because it means the real problem isn't how much money exists, it's how that money is structured. Keeping everything in one bucket, especially cash, creates a hidden trade-off. Liquidity is maximized. but growth is sacrificed. And over time, that sacrifice becomes expensive. A 4% return in a 6% inflation environment isn't neutral. It's negative. That gap compounds year after year. Over a decade, tens of thousands of dollars in purchasing power can disappear simply by staying safe. That's the invisible cost of outdated advice. And it gets worse when behavior is added into the equation. Because emergency funds aren't just financial tools, they're psychological tools. Cash feels safe, it's visible, accessible, predictable. There's no volatility, no fluctuations, no uncertainty, and that feeling overrides logic because the fear of not having money during an emergency is immediate and vivid, while inflation is slow and invisible. So decisions get made to avoid fear, not to optimize outcomes. That's why so many people end up like Lauren, doing everything right and still losing ground. Not because the idea of an emergency fund is wrong, but because the structure is outdated. And here's where things start to shift. Because once emergencies are viewed as layered instead of singular, the solution changes completely. Instead of asking how much cash is needed, the better question becomes how different types of emergencies should be handled. Some require instant access. Some allow a few days. Some unfold over months. And when those differences are acknowledged, a new model starts to emerge. Not a bigger emergency fund, a smarter one. That's where the tiered emergency system comes in. Not as a replacement for safety, but as an upgrade to it. Because the goal isn't just to survive emergencies anymore. It's to survive them without quietly losing financial ground at the same time. And that requires a shift away from the idea that all emergency money needs to sit in cash, untouched, waiting for a worst-case scenario that rarely happens in the way people imagine. In fact, most people never fully drain their emergency funds. Data shows that only about 11% of households with emergency savings use more than half of it in a given year. That means the vast majority of that money just sits there, not being used, not growing meaningfully, losing value slowly, year after year. That's not protection. That's stagnation disguised as safety. And once that becomes clear, the conversation changes, because the question is no longer whether an emergency fund is necessary. It absolutely is. The real question is whether the traditional structure is still doing its job. And the answer is increasingly no. The shift starts when the structure changes, because once it's clear that not all emergencies demand instant cash, the idea of keeping everything in one place stops making sense. The real goal isn't maximum liquidity at all times. The real goal is matching the type of money to the type of problem. That's where the tiered emergency system comes in, and it changes how safety actually works in practice. Instead of one oversized pool of cash slowly losing value, the system breaks protection into layers that behave differently depending on what happens. The first layer is immediate survival. This is the money that needs to exist without delay, without friction, without any risk of timing. 3 months of expenses, sitting in a high-yield savings account, fully liquid. This covers rent or mortgage, groceries, utilities, insurance, everything that cannot wait. This is the money that handles the kind of emergency that shows up on the Tuesday and demands resolution by Friday. Car repairs, urgent travel, a sudden bill. These are real, but they are not massive, and that's the key distinction. The majority of financial shocks people face are short-term and relatively contained, not catastrophic. The second layer is where the old model completely breaks down. Because the 6-month rule assumes that everything after month 1 needs to be just as liquid as day 1. But real life doesn't move that way. A job loss doesn't require 6 months of cash immediately, it unfolds. Expenses get paid over time. Decisions get made over weeks. There is space to react. That's where the next 9 months come in, not as idle cash, but as structured money. A CD ladder or similar fixed income structure allows portions of that money to become available over time while still earning more than a basic savings account. Instead of sitting still, that money works in the background, generating returns while still remaining accessible when needed. It's not about chasing high risk, it's about avoiding guaranteed loss. Because that's what the all-cash model does in an inflation-heavy environment. It guarantees loss in real terms. And then there's the third layer, the one most people ignore until it's too late. Healthcare. This is where even well-prepared retirees get caught off guard. Costs don't just rise, they behave unpredictably. One event can disrupt everything. And even at the baseline level, the numbers are already significant. The Medicare Part A deductible alone sits at $1,736, and that's just the entry point, not the total cost of care. That number doesn't exist in isolation. It stacks on top of premiums, prescriptions, follow-ups, and everything else that comes with medical events. When that kind of expense hits a general emergency fund, it doesn't just reduce it. It destabilizes the entire structure. That's why separating a dedicated health emergency fund changes the equation. It isolates one of the most unpredictable risks into its own category, preventing it from spilling into everything else. Now bring this back to Lauren, because this is where the difference becomes real. The original structure gave a sense of certainty. 6 months, one number, one account, done. But it didn't account for how reality actually unfolds. So the structure gets rebuilt, 3 months stay in cash. That doesn't change. That's the foundation. The next 9 months move into a CD ladder, not locked away blindly, but staggered in a way that creates access points over time. Some portions mature sooner, others later, creating a steady flow of availability instead of a static pile. And then a separate health buffer gets created. Not massive, but intentional. Enough to absorb that initial shock without forcing everything else to collapse. At this point, something subtle shifts. The question is no longer, is there enough money? The question becomes, is the system built to handle how problems actually happen? And that's where the stress test comes in. Because numbers on a screen don't tell the full story. Plans look solid until pressure gets applied. So the test starts with something simple. Monthly expenses. For Lauren, that number is $8,700. That's the baseline. That's the number everything was built around. But that number assumes stability, so it gets adjusted. Not dramatically, just realistically. A 20% increase. Because that's what tends to happen in difficult periods. Costs don't stay flat, they expand. Insurance premiums rise. Healthcare expenses appear. Convenience spending creeps in, especially under stress. Even retirees fall into this pattern, where small recurring expenses quietly stack up over time and push actual spending beyond expectations. That 20% increase takes $8,700 to just over $10,400 per month. That's the new reality under pressure. Now that number gets extended across time. 6 months at that level isn't $52,000 anymore. It's over $62,000, and that's assuming the disruption ends at 6 months. Stretch that to 9 months, which aligns more closely with current recovery timelines in a volatile labor market, and the number moves past $93,000. Now the gap becomes obvious. The original emergency fund wasn't just slightly off. It was built on assumptions that no longer hold. And that's the part that changes behavior. Because once the system is stress tested, the illusion of safety disappears. Not in a dramatic way, not in a panic-driven way, just in a clear, mathematical way. The margin isn't there. And that's where the tiered system proves its value. Because instead of relying on one number to carry everything, it distributes the pressure. The first 3 months absorb the immediate shock. The structured 9 months extend the runway. The health fund prevents a single unpredictable event from collapsing the entire plan. And most importantly, the money that isn't immediately needed isn't sitting idle losing value. It's positioned to at least keep pace, if not slightly outpace, inflation. That's the difference between static safety and adaptive safety. One assumes nothing changes, the other is built for constant change. And in 2026, change is the only constant that matters. This is also where psychology starts to shift, because the fear that drives the all-cash approach begins to lose its grip. The fear is always the same, not having access when it's needed. But the structure already solves that. Immediate needs are covered. Short-term needs are covered. Long-term disruptions have a plan. So the need to overcompensate with excess cash starts to fade. And what replaces it is something more stable. Control. Not the illusion of control that comes from a large static number, but actual control that comes from a system designed around how real life behaves. And that's the point where the old rule fully breaks. Because the 6-month emergency fund was never designed for this kind of environment. It was designed for lower inflation, more predictable costs, and faster recoveries. It worked then. But now, it creates blind spots. It hides risk instead of managing it. It feels safe while quietly falling behind. And that's what makes it dangerous. not because it's completely wrong, but because it's incomplete in a way that's easy to miss. The people who follow it aren't reckless. They're disciplined. They're doing exactly what they were told. And that's exactly why the outcome is so misleading, because discipline applied to outdated advice doesn't create safety. It creates false confidence. And that's the real risk in 2026. Not overspending, not lack of effort, but building plans on assumptions that no longer match reality. The solution isn't more fear. It isn't hoarding more cash. It's upgrading the structure, layering risk, matching money to time horizons, separating unpredictable costs like healthcare from general expenses, and most importantly, testing the system against real-world pressure instead of ideal scenarios. Because once that's done, the difference becomes obvious. 6 months isn't a safety net anymore. It's a starting point that needs to evolve. And the people who adapt that structure aren't just saving more. They're staying ahead of a system that's constantly shifting. That's what creates real financial stability now. Not a number, a design. And once that shift happens, the entire approach to money changes. Because it stops being about reaching a target and starts being about building something that actually holds under pressure. If this changed the way emergency funds are seen, and if the idea of structuring money instead of just storing it makes sense, then that's the signal to go deeper into strategies that actually match today's economy. Subscribe for more insights built around what's real right now, not what used to work.